The other day, I put out a video going over the top 3 stocks on my watch list, with one of those stocks being Foot Locker, the large shoe retailer predominantly focused in the US, but is expanding into other markets right now, as we'll get into. But I wanted to take the opportunity to do a deeper dive on Foot Locker stock now, to take a look at the business fundamentals, the potential risks versus reward that you might see with a company like Foot Locker, as well as some of the news around it right now, seeing as though the stock recently took a beating, and maybe that'll open up an opportunity for someone with a value-oriented lens towards stock investing. But I do want to emphasize that this video should not be taken as financial advice, especially because your risk tolerance might be very different. Your assumptions that you make on the company might also be different, and you really just have to do your own research before you make that call. Anyways, if we take a look at Foot Locker stock right now, we can see that it is down 12% today after releasing earnings, and they actually beat their earnings expectation, but they left some potentially bad guidance for investors that's scaring people away. We'll get into that in just a second, but let's take a look at some of the higher level fundamentals of Foot Locker before we try to make any sort of decision on whether it's a buy. Anyways, if we head on down here to financials and then go to balance sheet, we can take a look at kind of what the general position of Foot Locker's money and assets and liabilities, what are they looking like? It looks like they have about $1.8 billion in cash and cash equivalents, so that's a good start. They have about $1 billion in inventory, which is important as a company that sells things. As a retailer, they sell shoes. But I want to go ahead and skip on down to long-term liabilities, and it looks like they don't actually have any long-term debt, so that is a great start. They don't have a bunch of debt to worry about. However, they do have leases, which work as debt, and that's why they're on the liability side. So any sort of store lease, that's going to go against their liabilities, and that's a pretty substantial amount. They have about $2 billion worth of leases to worry about. And they've actually kept their share count pretty stable. It's gone down in the last year, which is a good thing. That means they're buying back shares and they're not diluting shareholders in a big way, though we did see a tick up from Q2 to Q3, so that's something to pay attention to. Let's actually flip this over to an annual view, or last 12 months maybe. We'll go to annual and see what the total shares outstanding looks like there. And yeah, significant share buybacks over the last few years, going from about 131 million shares a few years ago down to 103 or just over 100 million shares now. So that's a significant amount of buybacks that have taken place over the last few years. And that would be a good thing for investors generally, because it means that you are actually getting a greater ownership in the business and its underlying earnings. That's why share buybacks are something that are good for investors, generally speaking, as long as the company's not overpaying for its own stock and it couldn't be using its money more productively elsewhere. Share buybacks are probably best compared to a sort of dividend, whereas with a dividend, the company's just giving you cash straight up. You're taking the cash as a distribution. Whereas in this case, with a share buyback, the company is buying back the share, and now there are less shares outstanding, which means that each individual shareholder has a greater share of the actual profits of the business. So you're getting a greater ownership that way. I guess you could say it's a sort of hidden dividend. But anyways, at least on the balance sheet side, there's not a whole lot that's jumping out. They have a nice amount of cash. They don't have a bunch of debt. They have leases to worry about, which is something to keep in mind in this more and more e-commerce focused sort of economy. Having a bunch of physical stores might be very expensive, and that could be dead weight depending on how you want to weigh that. So we'll keep that in mind, but really nothing too alarming in my opinion on the actual balance sheet side. Of course, do your own analysis, because you might want to see more cash for a company. You might want to see them take on more risk and take on more debt to be more aggressive with things. You might want to see even less buybacks. You might want to see them actually reinvest their capital in a big way. Speaking of which, let's see what their actual return on invested capital is. For Foot Locker, over the last 5 years, their average return on invested capital, which is a measure of how well they invest the money into the business, whether that be from debt, from cash they raise, how are they investing their money within the business? What is the return they're getting? Well, over the last 5 years, that's averaged around 12%, which is a very strong number. Of course, beauty's in the eye of the beholder, and it depends on the industry they're in and what you might think they could do in the future. But in the past, they have done a pretty good job of investing their capital. It's always a good sign. You do want to see that number being higher, because that means they're better at investing their capital. But what about cash flows? Free cash flow is something that I always want to take a close look at whenever I'm looking at any company to invest in, because that's really the lifeblood of the business. Free cash flow can be used to do all sorts of things, whether that be reinvesting back into the business, paying shareholders, all the nice things that come with owning a profitable business. And free cash flow is calculated by taking cash from operations that the business is throwing off and subtracting capital expenditures. That's the general way of calculating free cash flow. We could actually see this graphically. The blue bar is their cash from operations and the capital expenditures are the black bar. So we want to see the blue bar growing faster than the black bar, generally speaking, because that means that their free cash flow is growing. So as you can see, it did take a bit of a decline going into 2020, but coming into 2021, they've seen substantially greater free cash flow, which is a great sign. That means that they've weathered the storm of the pandemic and even all the supply shortages that are going on as well. They've been able to keep their cash flows up and appear to keep growing them as well, which is fantastic. And with the drop off in their stock as of the filming of this video, Foot Locker is currently trading for 7.5 times their current free cash flow. And while we're on the topic of multiples, Foot Locker is currently trading for about a 5 PE, or a price to earnings ratio. And over the last 5 years, their PE has actually been a lot closer to 10. So that would suggest that relative to their historic trend, they are relatively cheap to their own valuation, at least in years past. But that doesn't mean that the current PE is incorrect, because it depends on what your future expectations are for the company. Because if a company has a low PE, that could simply be a sign that people think the company is going to shrink, or that it is comparatively overvalued, or there was some fluke earnings season that they're not going to be able to keep up, and therefore it's going to shrink. So you're going to see the PE expand that way. So let's take a look at what the future might hold for Foot Locker. As of today, they reported their big earnings beat, and they say that their inventory levels are ready for the holidays, but the stock fell because they issued some warnings about supply chains and the common issues that actually a lot of sellers of pretty much everything are facing right now, as global supply chains have seized up in certain places or have gotten significantly less efficient. And this article attempts to explain some of that, why Foot Locker stock fell 12% out of the gate today, what happened. Foot Locker reported third quarter 2021 sales of nearly $2.2 billion, which was an increase from the $2.1 billion it pulled in the previous year. So good to see that they're on the right track. Revenues are growing. On the bottom line, the retailer's adjusted earnings came in at $1.93 per share this year, up from $1.21 in the third quarter of 2020 and $1.13 in 2019. So again, seeing that nice earnings growth over time. These results notably came as Foot Locker continues to adjust its store base, with 2,956 stores at the end of October versus over 3,000 a year ago. So they've actually been consolidating a bit, but we are seeing same store sales generally going in a positive direction. And this seems to be part of a general consolidation effort, perhaps trimming some of the inefficient stores out of their portfolio and focusing on the big winners. But generally, it's interesting to see that as the number of stores has shrunk, we've actually seen earnings increase. But moving on down the article, after that list of positives, most investors would expect a stock to be on the rise, and yet that didn't happen here. The problem could be that Foot Locker warned investors that supply chain issues could be a headwind through at least the fourth quarter of the year. This is generally the most important selling period for retailers, given the big gift-giving holidays that occur at the year end. So generally, you're going to see some sort of surge in sales for just about any seller, at least in the US, where there's a lot of holiday shopping. But management did stress that they've built up a good amount of inventory in preparation for the holidays already, so we'll see if that ends up panning out. But that's very short-term focused, looking quarter to quarter. What about the long-term trend? What is Foot Locker really doing? We already talked about how they're consolidating stores, and they're definitely focusing on the e-commerce space as well, but they're also trying to grow into other markets. As we can see here, Foot Locker shells out $1.1 billion to acquire 2 athletic retailers, and those specifically are WSS, or their parent Eurostar, and then also Atmos, or at least their parent company. And this was announced a few months ago, and WSS specifically is kind of the west coast of the US. It's focused there. They have 93 off-mall stores, and Foot Locker itself, the main brand, I suppose, is focused in malls throughout the US. But Atmos, on the other hand, gives Foot Locker a highly strategic foothold in Japan and a chance to grow its influence in the rapidly growing Asia-Pacific market, with 49 stores globally, with 39 of them in Japan. So they're going the acquisition route to try and grow the company in new markets. We'll see how that pans out. I think that is one of the bigger significant risks with Foot Locker. It's how well can they invest this capital? They've done well in the past. They have a pretty strong ROIC, return on invested capital. But how is this going to pan out with these other investments, with Atmos, with WSS, if they invest in other companies as well? Because $1.1 billion for a company that just recently had about $1 billion in cash on its balance sheet, that is a lot of money. That is a significant amount of risk for a company of this size with about a $5 billion market cap. But as with any company, the big question is, how fast are they going to grow their revenues over time? How fast are they going to grow those free cash flows? How are they going to invest those free cash flows to produce more growth? Those are the big questions that are up to the investor to decide side. How do you want to weigh those risks? How do you want to weigh those probabilities? With the large dip today, I did open up a very small position. It's near what my personal price target is. I'm not going heavy into it at this point. I think if it drops some more, I'd probably be very interested in doing that. But again, we'll see. I do want to do some more research before I get more aggressive. But overall, I think the direction for Foot Locker is positive. It's whether they can continue this momentum and continue to grow their cash flows and continue to do well with their current position. I think as long as they don't get too reckless, but also not too complacent, they should be in a really good place because they already have a pretty strong brand presence, at least within the shoe community, at least in the US, and we'll see if they can expand that presence into other markets as well. So that's a look at Foot Locker. It's an interesting stock, and I'm interested in buying more of it in the near future. It'll kind of depend on where this price goes in the next few weeks to see if it continues to dip on the news with the guidance that they're worried about supply chains and all that, see if they can actually weather that. I would tend to think that they could weather it, but who knows? It's really anyone's guess at this point. But I'm focusing on the long term. Sure, they might have a bad quarter here and there, but it's whether they can continue to grow over the years and continue to have decent results. And if I can get it at a really good price compared to those results, then that makes the position that much stronger. Anyways, that's all I've got for today. So if you like this video, please like it, since that would help the channel out a lot. And if you like this sort of content about investing and personal finance, then definitely subscribe, since I put out new videos every single week and wouldn't want you guys to miss out. I'll definitely have at least a couple more stock analysis videos in the very near future, going over the other stocks on the watch list that I mentioned in the previous M1 Finance video. I'll go ahead and link that above right now. But in any event, looking forward to seeing you in the next one. Until next time, take care.